So, Happy New Year for office hours. We're going to be joined, as always, by our good friend, Professor Mark Guthner of Rutgers, today on Open Interest. Hello, everybody, and welcome. And hello, of course, to Mark Guthner. I thought one of the things we could do today is just have a sort of a general conversation, something I actually started on the Open Mic live stream yesterday, where I was just talking about factors that may or may not necessarily have a really good predictive quality from one month to the next, but where the net effect of these things, so these are sort of more fundamental factors in some cases and others are technical, have a really important cumulative effect. I have just a handful that we could potentially talk about, but before we get to that, Mark, how are you, my friend?
Doing very well. Teaching has already started for me. I'm doing orientation to the Masters of Quantitative Finance students this week. And then school will start officially next week, and we'll be doing back to the old grind. So, but the way I kind of look at it is we're at the peak of the hill now. Now we're going to summer, and the weather should be getting better over time, and spring will be arrived in no time, and new things
The
will
days
happen.
are getting longer. That's the part that I like. I feel that, going into the third week of December, always that's a little bit grim. Now, admittedly, that was a period when I was in Hawaii, so that was actually pretty good. The sunset in Hawaii was not so early in the day.
Yeah.
It was probably a little after 6. I think it wasn't too bad.
Yeah. Well, when I used to work in London in the wintertime, most people don't realize that London is almost as far north as Moscow is. And so I would walk to work in the dark and come home in the dark. So and the dark would be like at 3:30 in the afternoon. Like that.
Yeah, I have a lot of family that lives in Europe and primarily in the Netherlands. And that is also a place where the days are exceptionally short in winter. And I remember as a kid when I would go to visit them that it was pretty common for cars to have their headlights on all day. That's also a function of the fact that it just tends to be in the winter, foggy and damp and rainy in that part of the world at that time of year. Of course, the summers are terrific because the days are exceptionally
Very long.
long.
Yeah. Almost
Yes.
in London, it's almost like dusk for about 8 hours. It doesn't like
Yeah.
really get dark. It's very strange. The other thing that's strange about London in the winter is that it's colder in the evening than it is in the morning. Like walking to work was not bad, and I'd always, oh, it's not too bad. I'd be underdressed for walking home, and I'd be like freezing my brains out
Well,
walking
that's like
home.
here in San Francisco. San Francisco, when the sun goes down, it cools off. Inevitably, people are always underdressed in the evening
Hmm.
here, has been my
Yeah.
observation. While you were talking about the Masters of Quantitative Finance program, I thought it would be interesting for us to just think about data, about things that we often talk about in terms of investing. And I got 10 years worth of data on a couple factors.
Okay.
And I just wanted to talk a little bit about, data analysis and its utility in investing, what the implications are over the long term, but also how it can and be used, but also how it doesn't necessarily have much short-term utility necessarily, but that doesn't mean it should be ignored. So I have a chart on my screen. I've got 5 charts, and I didn't order these in any particular way. But I just thought they would be interesting. And we can, if we want to, it probably wouldn't take me too long to create charts on some other factors if we wanted.
Okay.
What we're looking at here is the universe of U.S. publicly traded equities. And what I did was I took that universe of stocks over the past 10 years and looked at forward EPS growth estimates So at the time, so this would be the forward earnings per share estimates at the time, and evaluated the performance, the relative performance of buying the stocks that were in the top 20th percentile, so 80th percentile and above, and compared their performance to that of the bottom 20%, right? So that's the 20th percentile and below. Now, the results here probably don't surprise people tremendously, but what you see is that the cumulative returns for stocks that had higher growth expectations was considerably better over the course of time than it was for the lowest quintile, if you will. So that was one thing that I thought was interesting. And the purpose of this was that when we think about trade ideas, we're usually trying to establish what we think is going to be important in the near term, 30, 60, 90 days, maybe even by the end of the year. When we think about fundamentals, we're usually trying to think about things that will have a tendency to generate meaningful returns over time. What they do from one day to the next, 1 week, month, or even quarter, is a little less easy to determine. And in fact, in this case, the outperformance, like the hit rate of outperformance for any 30-day period, is not that great. It's in the 50s. So stocks with with higher EPS growth estimates will tend to outperform, but the amount by which they are over any 30-day period is relatively small. So let's take a look at another one. I think it's kind of
just to be clear on that, that's not comparing fast growers with slow growers, but companies that are expected to be fast growers versus expected to be slower. Is that right?
Correct.
Okay.
Correct.
All right.
So this is forward. So this is forward-looking. So this is just based on estimates. Now, the idea here is that I'm trying to look at data that we actually have access to. In other words, if I look backwards and I say, oh, well, look, NVIDIA way outperformed the rest of the world, and their earnings grew so much faster. Well, we know that now.
Yeah.
But what did we know then is really the question.
That's what I wanted to get to, because can we use that for some kind of predictive ability?
Yeah, so this is just like, what are the things we can think about that are going to be important over the course of time, over the course of an investing career or lifetime? What does matter and versus what doesn't, that you would know, that information you have available to you. So here's also information that you have available to you. What are we looking at here? What we're looking at are earnings per share revisions that for the upcoming quarter that have taken place within the last month.
Mm-hmm.
Okay? So in this universe, what we're looking at are companies and whether or not sell-side analysts have revised their earnings higher or revised their earnings lower, right? So again, this is information that you had access to at the time, and you will see that it doesn't always outperform, and certainly there are periods when it didn't. But cumulatively, this is one of those things that matters. Now, what is also interesting about this particular piece of data is that this happens to have a very good what we call hit rate. Meaning that if you see companies that are getting positive earnings revisions, and if in general, all else equal, you bought those companies as soon as those revisions came out, the cumulative effect of that, and then got rid of them as soon as their revisions started to go down. Because what this is doing is it's evaluating this every single month. So this is 10 years. And at the beginning of every month, you say, okay, I'm going to sort rank companies. Those that had the biggest positive earnings revisions, I'm going to buy those. And, the bottom performing one is the orange line. And you can see that the cumulative effect is fairly pronounced. So, in other words, earnings, we tend to dismiss what the sell side says and does sometimes because it often feels like they're just playing catch up. And of course they are. But in the grand scheme of things, it does matter. Now, I would add one other thing, which is that earnings per share revisions in this context, because it's looking at all the published data, one analyst raising their earnings per share is not as meaningful as, let's say, there's 30 analysts covering a stock. If all 30 raise their earnings per share estimates, that is going to weight more heavily than one that just has one revision. And similarly, if everybody's turning bearish on it. So there too. This one, I kind of touched on this because I look at, every time we talk about stocks, we look at free cash flow relative to the market capitalization, relative to the enterprise value. And here too, the higher the free cash flow yield, the better performance. What I find kind of interesting here is that this has really been, and now I wonder whether you have any insights into why this might be true. But notice when the outperformance really started to happen. You see this? Like these.
Yeah, I can't read the bottom of the screen there, the dates.
Okay.
So where's the peak of that orange line, for example?
The peak of the orange line right here is about 100. This is in, right here is where you're talking about. So I'm just going to go straight down, or as straight down as I can. That is June of 2021. So we're.
Okay.
And actually it's early, it's late 2020, early 2021 when these things had basically, their cumulative returns had been about the same. And then since that time, higher free cash flow yield has significantly outperformed. I mean, it's not even close. It's more than double the performance.
And the orange line is, what is that telling us?
Well, the orange line actually, this is companies with lower free cash flow yield, the bottom quintile, and this is the ones with the top quintile.
All right, cool.
Free cash flow yield, right? So that's just a simple metric. Now, it's fair to say that the companies that have had exceptional free cash flow yield would include, Microsoft, which I think at one point was trading at a sub-20 forward earnings multiple. Alphabet, obviously, Meta. You have some companies that had very good EBITDA numbers and growing EBITDA. That would be Amazon, for example. Didn't have huge earnings for a while. They sort of have turned the corner on that. There was always that long suggestion that the company was investing in their future. They valued themselves on EBITDA. If they had any additional excess money, they would tend to invest it in the business.
Okay.
But I think this is kind of interesting thing to keep an eye on. But I was very curious about the timing of this divergence.
Yeah, it is. It is interesting. Just to make it clear that this is a simple average of the names, right? Not there's no like market weighting or something like a large caps are not weighted more heavily in this line than a small cap.
That is correct. Okay. It's a simple average, and it's rebalanced monthly.
So 2021. That's when the interest rates started to rise, right? Or shortly thereafter?
So that was really 2022. Let's take a look. I'm going to pull up the 2-year, and we will pull up that. I'm going to bring that down to the screen. And it was really 2022. So the change in performance really happened right around here. That's when it really started to see that divergence, and then there was a huge rate change that followed. But what I'm curious about was, is it possible that equity investors were anticipating? I mean, it's not like the inflation data we had, right? We already knew inflation was shooting up in 2021. Inflation basically really started to leg up right after the inauguration in 2021. It was around February, March, we started to see the first sort of real troublesome signs. And then by 2022, all hell had broken loose. We were at multi-decade highs in terms of inflation. So is it possible that equities were anticipating that? What do you think?
I think that's very possible, because what I was going to say is that with rates suppressed and we kind of have zero interest rate policy, maybe what's going on is it's allowing the zombie companies to keep up, but the companies that are not zombie companies, right, the ones that are making cash flow, they're doing just fine. But the zero interest rate policy allows the zombie companies to stay in the game, and so people could be speculating on those too. And once you think that those two are going to diverge, that okay, now that companies are going to have to really pay for debt, it would make sense to say, well, let's dump the zombie companies because they're not really quite so viable.
Yeah, do you want to just quickly, for anybody in the audience who doesn't know, describe what the zombies are? Because I have seen a couple people talking about zombies specifically of late.
Yeah, well, zombie companies are those that don't generate enough operating cash flow to cover their interest payments. Or maybe that's all they're really covering. There's nothing left over for shareholders. A lot of companies that are doing very poorly, maybe some retail companies that were barely hanging on, but since their cost of debt was almost zero, they could go get a loan and kind of stay in business and just use cash on the balance sheet to make their debt payments. And then when there's got a real cost, that game comes to an end. This is, I think, what probably caused Japanese stock market to languish for so long, because when they jammed interest rates down to zero for essentially, what was it, 30 years, their stock market really didn't do anything. And their economy was kind of okay, but their stock market clearly didn't do anything. That's one of the companies, as an aside, are examples of, well, maybe stocks for the long term is not a hard and fast rule, because if you bought the Nikkei in December 31, 1989, you're breaking even about now, which is a long time to wait to make
that
money.
Is, and yeah, I mean, and on a dollar basis in other currencies, you probably still have not.
No, not even close.
Really fully recovered.
Not even close.
Let's actually take a look at that. I think I'm gonna just bring that in really quickly. So this is the Nikkei. Let's take a look at the Nikkei for as long as we possibly can. Actually, it looks like it has broken out over that high. So let's see here. This is, by the way, this is just quarterly ending, so this is not going to have the all-time high in it. But yeah, as you point out, it was just only recently that it actually got back above its 1989 high. That's a quarter ending, right? But on a dollar, on an inflation-adjusted basis, that's, nominally that's nothing, right? Because the value of a dollar is a very different thing in 2025 when this took place than it was in 1989. So yeah, that's quite interesting. So, looks like we lost Mark, but I understand that he has a toddler running around in his house right now, so that is going to happen. He had to go check on him. Let's take a look at another chart, though, while we wait, which I think is sort of in the same vein, if I can get this to go. And it exhibits kind of a similar characteristic. So what we're looking at here is the sales to price. So a higher sales to price would be companies, and again, you're dividing the revenues of the business by the price of the business. So if you have welcome back, Mark.
Sorry about that. The little one is having a breakdown.
I get it. So I just moved on to another slide here, which happened to have a divergence that was approximately coincident. It's not quite. And actually, let me just back up so we can just notice the difference a little bit here. But you can see that it's around the same time.
Yeah.
Around the same time that we see in this case, it's a little bit laggy. So here, free cash flow yield, we can see that the prices of these stocks basically were coming out of the pandemic plunge together. And then at some point in early-ish 2021, companies that had really good free cash flow yield continued higher, much higher.
Mm-hmm.
And companies that did not began to languish, possibly in anticipation of higher rates. Here we see a kind of similar pattern, but the timing is different. This is sales to price, so just revenues over the price of the company,
Okay.
as reflected by market capitalization. But again, this is a fundamental value question. In other words, people look at things like price to sales. We look at free cash flow yields. Those are more of a fundamental tool for analysis. And then finally, this is a technical one.
Let's go back to the other one because what's important, that ties back to growth, because I'm going to guess the blue line has high price to sales ratio or sales to price ratio.
Sales to price, yeah. So that means that the companies were cheap relative to revenues in this case.
So that's the opposite of what I was thinking. I was thinking that high price to sales were doing better because they were growing faster. But I was thinking I was thinking upside down.
Right, but what's interesting is their growth does matter. That's the first thing we took a look at. So growth and growth expectations, but growth matters. But what this tells us is there is some intuition. Now, remember, this is a big, big universe of stocks.
Yeah.
And that universe of stocks is changing a little bit over the course of time. I think your stroller is migrating out.
As long as he's not screaming and yelling, that's fine with me.
So here we go. And this is the final one. This is just a technical indicator, and it's just the price versus the long-term, the 200-day moving average is what we're looking at here. And here, too, I think this is pretty interesting because, there is an old saw that says nothing good happens below the long-term moving average.
Yeah.
And, what this chart shows us is that, there was some price appreciation. This is below the 200-day moving average right here. And, stocks were appreciating. And actually, from 2015 up until 2018, it didn't really seem to matter much, which I found very interesting. But it certainly seems to have mattered a lot more in recent years.
Yeah. I wonder if that's, again, a growth phenomenon. And I'm also wondering if this captures something of good news is followed by more good news and bad news is followed by more bad news on average, perhaps.
I think so. I think that's true. The reason I was bringing this up is because I very often, when we take questions and, when I'm coming up with trade ideas, these are things that I tend to screen for. And what I wanted to do here was simply to illustrate that over the long term, these things tend to matter. So these are big data sets. Like I said, I think that the universe of stocks averages, and I say the universe of stocks averages because there is a survivor issue.
Yeah.
U.S. Steel, ticker X, the company got acquired. It is in here, but it's only in here until it isn't, right?
Yeah.
So there are companies that have come out that get folded in, and there are companies that are no longer publicly traded or got acquired or whatever that are no longer in it. I think the average universe of securities that is being examined in all of this, it works out to about 3,700 stocks. And these are all U.S. stocks, by the way. I didn't look at this globally.
Mm-hmm.
And the reason I didn't look at it globally, I suppose I could. It introduces a lot of complications. Some of those complications include, currency fluctuations, for example. That would be a little bit problematic. And there are other things that can affect businesses in different locations that it becomes a little bit difficult. So there could be geopolitical things, there could be changes in tax policy that take place in certain countries. And I didn't really want that data to get sort of folded into the, because then you have to go back and sort of dissect, well, why did this happen and why did that happen? And it just gets a lot more complicated. Besides which, I think most people are principally invested in U.S. companies.
Yeah.
It's not the end of the world if you don't look at Royal Dutch Shell, for example, if you have Exxon, Chevron, Conoco, and the like. We don't really need to focus so much on what happened to Barclays if we've got J.P. Morgan, Goldman Sachs, and actually, Lehman Brothers wouldn't show up in this one because, of course, this goes back only 10 years. By the way, I only have about 15 years worth of data in total. And I did find that when I tried to do the analysis over 15 years, things kept breaking.
Interesting.
It could be, well, it could be I could be testing my computer's limits at times with data because I'm not really great and masterful with databases, so I do everything in Excel, and that can be quite taxing on a machine if you are not doing stuff efficiently.
Yeah.
So anyway, yeah, I thought this was kind of interesting, and so I thought we would just sort of start with that. I don't know whether we have any questions. I'm going to actually pull up my.
Mike, I don't remember if it was you that I was talking to this about a week or 2 or 3 ago. That the more people talk about a stock that we find online, the better the stock price does.
Yes, that is true. Yeah. So what I was actually, I don't know about like talking about a stock. A factor in the short term that seems to be incredibly predictive is the number of news stories about a company.
Yeah.
So if a company has, a lot of news stories about it, then it's going to tend to outperform those that have less. Now, when I was doing that, so the data I was just providing was basically for the entire universe of publicly traded equities in the United States. Yeah. Where you're going to start seeing a more profound divergence in companies that get more mentions in the news versus less is going to tend to be in the large cap indices. So now I'm talking about the Russell 1000. I'm talking about the S&P 100 and 500, things like that. And this should make some sense to us. The reason this makes sense is because actually out of however many publicly traded stocks there are, over 3,000 of them in the United States, on any given day, most of those stocks aren't getting mentioned.
Yeah.
And on any given day, there's a handful of stocks that are always getting mentioned. So you kind of have to sort of distill the group in your universe that you're examining down to a size that is probably more likely going to have, stocks that are indeed getting mentioned or not, right? So let's take a look. I'm going to take a look at the Russell 1000.
Yeah, I don't know if you're able to do that on the fly.
Yeah, I can do this pretty quickly. So let's see. Go to 7 years, 10 years. Okay, let's see what we have here. Where is my data on this? I had that around someplace. I'm trying to pull that up. Let's see. Was that not sentiment? I'm trying to remember what that. Short days to cover. No. All right. I know I had this in here somewhere, but I've got surprises. I seem to have lost that for some reason.
Okay, we can
not 100% sure.
Later.
Here, I have another function in Bloomberg where I can probably look that up, and I'm going to. There we are. Here we go. So, this is I accidentally am looking at the Nikkei. And yes, so here we're looking at the average number of stories. And we can see that this has a Sharpe ratio. In this case, this is, I think, only looking back 1 year, but it has effectively a Sharpe ratio of 3.7.
That's remarkable.
And a hit rate of 92%, with an average Q score of 1.4%. So what is it? Just to refresh everybody's memory, all this is doing is it's counting the number of stories about a publicly traded stock over the prior 7 days. And then then you rank sort it. So we're looking at the top quintile versus the bottom quintile. So in this case, there's 1,000 stocks, the top 200 versus the bottom 200. The average monthly outperformance for companies that are getting a lot of mentions is 1.4%.
Wow.
I mean, that's a lot. And the hit rate is 92%, which means that in a year, over any 1 month period, you're going to win far more often than you lose if you were going long the top 200 stocks with the most stories and short the ones at the bottom. Now, let's take a look at this list right now so we can get a sense of what those are. No big surprise that the company with the highest number of stories right now is NVIDIA. Yeah. Right? Followed by, look, this is almost a MAGA list, right? The Mag 7. But if we go down to the bottom, let's see how many of these companies folks are used to hearing about. Ingram Micro, Hanover Insurance. Ubiquity is hardly ubiquitous in the news. No stories about that puppy. Penske, which is the big auto dealer. Crane, Kemper, Cirrus, Snap-on Tools. We've got in here. Some of these companies will be like Dolby Labs. I'm sure a lot of people are familiar with what Dolby Labs is. But, just not a lot of chatter about the company, Williams Sonoma. Mm-hmm. So, I want to make another quick and important point about this, and that is that when we look at these things, it's entirely possible that some of this data is out there for similar reasons. Nobody's talking about these companies because there's nothing exciting to talk about. So if there's nothing exciting or interesting going on to talk about, that's the reason that those companies are underperforming. That's a potential reason. Mm-hmm. It is also a potential reason that if you talk a lot about a stock or a company, that investors become interested in it, and then they go out and buy it, and they drive the price higher, right? So understanding that relationships exist doesn't necessarily get straight to the bottom of why they exist.
Yeah.
And doesn't necessarily mean that one shouldn't buy, for example, Royal Gold, which is down here in the bottom, when maybe the underlying story for gold miners is quite good. In fact, there's probably, let's see, I was going to see whether there might be a gold miner that's also in the top 200, and there probably is.
There should be. There's.
I'm almost, in some ways, I'd almost be surprised if there isn't, but let's just take a look.
Well, one of the things I think is interesting about the gold market, I was talking about this with somebody yesterday, I was in class, is that there doesn't seem to be froth in that market. It doesn't, there are some gold dealers around us, and there's still no cars in the parking lot.
But how much gold, how much of gold...
It's like people don't want gold. Maybe if they're buying it, they're buying SLV and GLD instead. I don't know. But the point is there doesn't
and we have
seem
Newmont
to be like
in here. Newmont is in not quite in the top quintile, but it's close. Actually, isn't it? Because sometimes this doesn't start at the number one. Let's see. It doesn't. Oh, so it is. So Newmont Mining is in the top quintile right now.
Okay.
So we do have. So this is an interesting situation, and this is I bring this up because we have a bad tendency, whether it's in the news or whether it's in academia or whether it's in investing, to take a look at relationships like this and say, okay, well, how do we feel about it? You still have to do other work.
Mm-hmm.
That is to say that once you've established, okay, well, I prefer to look in this universe. Some of these things are not the kinds of things that I happen to look at. News, for example, is not one of the things that I filter for.
Yeah.
I go to this screen every day. This is not, and that's why I fumbled around a little bit to find it, because there's 250 factors that are available to me in the Bloomberg terminal to try to screen for. And this is just not one of them, because I'm assuming that the reason that companies are more newsworthy or less newsworthy is sort of coincident with other things that I would be looking at that actually are the ones that are going to drive the security's price. So whether that's good technicals, whether that's good fundamentals, whether that is changes in earnings or revenue estimates, those are the types of things that, to me, are more likely to drive the stories. And so I'm kind of looking at this as that's just something that's inclined to happen once the stock starts to move or is given a reason to.
Mm-hmm.
What are your thoughts?
I think you're right. I think you're reading those tea leaves correctly. I don't really have anything to add to that. I think that's right.
With your students, what types of, sort of data analysis are you guys going through? Because presumably, you spend a lot of time teaching kids how to value a business.
Yeah, well,
right?
I spend all our time on individual companies, not necessarily strategies. Maybe some graduate students are going to get into that, or they get into portfolio management class. But the intro to finance class, the investment analysis class, the investment analysis class, I spend a fair amount of time on how the students should prepare their life and think through their life on how much money they're going to need to save through time, invest.
Home economics?
Yeah, it's a little home economics for revenues minus expenses, and now you've got something to save, and how much do you need to save in order to get your down payment for the house, and then have kids, and then have vacations, and then eventually retire, send the kids to college if that's what you want to do, and then retire. And so it gets them to think about investing and to really avoid cash. I spend so much time talking about that, because between taxes and inflation, cash and cash equivalents is one of the greatest losers of all time. So the government, whether we like it or not, are going to tell you whatever story they want to tell you, but they're going to try to have the inflation rate be higher than the money market rates. Because the government loves to borrow money at treasury bills, and they would love to borrow money at a rate that's below the inflation rate with treasury bills, is one of the ways of helping balance its budget. And so that's really a bad deal for anybody that's buying that. So I think of treasury bills as sort of like an option. It's an option to buy stocks in a crash. So like a soft put. But buying put options is not a good long-term strategy.
I'm glad you bring up the sort of the liquidity consideration, because you and I have now lived through, and I suppose every generation does, some significant choppiness in our industry.
Mm-hmm.
You worked for a bank, and that bank ended up acquiring another one. I'm talking about Bank of America acquiring Merrill Lynch.
Yeah.
And but Merrill Lynch, even though Bank of America bought Merrill Lynch, the investment banking portion effectively took over Bank of America. And that was disruptive, because, and I know it was disruptive to your career, because when they take over and you've got two strategists, well, if Merrill Lynch's investment bank is taking over Bank of America's, that strategist stays and Bank of America's strategist goes.
Yeah.
And I think that's kind of what happened to you. You and I both also worked for another small investment bank at CRT that went out of business. I mean, it went out of business kind of. It was still alive, but it was a kind of out of business before we got there, and then it subsequently went completely out of business.
Yeah.
And it essentially got acquired.
Yeah.
But, you and I both know people who worked in the industry, and much of the wealth they managed to accumulate over time was in equity in the businesses for which they worked. Bear Stearns, Lehman Brothers, as it happens, perhaps Merrill Lynch. I had one of my best friends and a college roommate worked for Merrill Lynch, and they had an interesting incentive program, which is not uncommon for employees not only of banks, but of all kinds of publicly traded companies, where you could take a significant portion of your salary in the stock of the company for which you worked at a discount to its prevailing stock price. In his case, if my memory serves, it was 15%.
Wow.
And my wife has been looking at a job at a very large publicly traded company, and they offer a very similar program to this day. You get RSUs, restricted stock units, as a portion of your compensation at a material discount to the current stock price. Now, the downside of that, there arguably are two. The first is that you have significant concentration, right? So you're saving your money, but you're saving it all in one place. That's a little bit risky.
Well, you're doubling up.
The other part is
because that's where your income is coming from.
Well, yes, and then of course you have another situation where, in many cases, these are restricted. These are not free to trade securities either.
Yeah. Okay.
So even if you, from your vantage point, having insight into the business's affairs, begin to recognize that things are maybe not going so great. If you worked, for example, at Lehman Brothers, and you worked in the mortgage bond business, you might have recognized, hey, wait a minute, this market's starting to get chopped up here, and we are wearing about $700 or $800 billion worth of these things on our balance sheet at any given time as we package them into securities for sale. Maybe that's a risk if things start to go sideways. But you can't sell your shares, and now, only to make things worse, so suddenly you're out of work. Suddenly a lot of your savings have been annihilated. And if you don't have some significant liquidity or cash available in that circumstance, you might find yourself saying, well, I better sell my house because, this house in New Canaan, Connecticut's getting a little pricey here. And I'm going to have a liquidity problem. And I need to sell it, but if you don't have significant cash or cash equivalents available to you, you can really get into a situation that's upside down. I won't name the person and I won't name the bank, but I will tell you that I know somebody who was in our business, bulge bracket investment bank, MD level person, who found themselves in a very difficult situation. Had a huge house in Greenwich, and the guy went bust. I mean, completely bust. Which is almost unimaginable. You know, if you had said to him 2 or 3 years earlier, millionaire many times over, who was basically on top of the world, that, he would be completely bust 5 years after that. I don't think that was not within the realm of possibility, but that was a liquidity issue. It was basically that perfect storm of, a concentration of all of your wealth at the firm for which you worked. And that is very common in our industry. It's actually a situation I found myself in on more than one occasion, just by the virtue of the way it works. And then the business itself becomes impaired, and then you hold a bunch of illiquid assets, and you're in a really difficult situation. So to your students, I would strongly encourage that however much liquidity you think you need to have, I would start with this: double it. I don't know what your thoughts are. I mean, you probably found yourself in a similar circumstance.
Well, I wouldn't. The one of the things is when I think about diversification, it's also within their career. I would never. I would tell these guys, yeah, if you get a very senior level position, you're going to get stock incentive options or stock itself, restricted stock. But your day-to-day income is now correlated with your investment portfolio. And if you were somebody at Lehman Brothers and you did the same thing, you lost your job at the same time, your portfolio went to zero. And so that's not a good thing. And I know one of the things that we used to do at Bank of America was help CEOs hedge because they owned a lot of stock when their companies go public. And how can we do some kind of 3 or 4 year hedge so that they don't have to sell their stock, but if the wheels fall off, they're not clobbered. And things happen that you can't anticipate. But anyway, that's a big part of that is plan that out, figure out what it is it's going to cost you. I call it liability based investing. Your liabilities being what is it that you want to do? Not only pay all your bills, but second house, what kind of car do you want to have, vacations, hobbies, how many kids, where they do public school, private school, all those questions about life, they all have a financial impact. And then how can you arrange your financial affairs to meet those desires that you might have? And not the least of which is, a lot of people go and want to start their own business. I have students that as soon as they graduate from school, they want to start a business. Others want to do so after year 5. So how can they put themselves in a position where they can do that? And so that's what we do there. We don't, the MQF students, I don't happen to teach any of those. They're the ones that would get into these various strategies that you're talking about with the factors and things like that. The school also does a class in ETFs. Factors are a factor in ETF construction. So I'm sure they get involved. I don't know to what extent they're using the Bloomberg to do it, but one of the things that they do is they build teams and they design an ETF, and then they have industry executives come in and rate the idea for the ETFs at the end of the semester.
So obviously, as you know, I do some work with an ETF firm that manages I don't know, a little over 40 billion. I don't know exactly what the numbers are. It's probably 40 or 43 billion in that neighborhood right now. The CIO is not using Bloomberg data for the security selection per se, but the data that's available in this mechanism is also available in that firm's systems.
Mm-hmm.
And a lot of these are the things that are looked at. ETFs are increasingly actively managed, which is traditionally the spot that you would think of as your stockbroker might be partially actively managed. Stockbrokers would come up with ideas. Oh, we think it's time to sell IBM, and it is time to buy, Procter and Gamble. I can still remember my father's stockbroker would actually come to the house once a quarter. I think, it was a guy at Edward Jones or one of those firms, and I can remember they would all sit around the dining room table, and the guy would literally take out a little book, and in his book he would have a list of all of the different stocks, and he would talk about each stock had basically a little paragraph on it, and he would talk about the reasons why you might want to buy it by their work. What's interesting about that now, of course, is that this thing was printed, and they're not printing those things every day or every week. So he would literally come in and say, "Oh, we think you ought to buy this business and sell that business," for information that was, by modern standards, incredibly stale.
Yeah.
And also, with the benefit of hindsight, I used to think of that as, oh, this is valuable insights. This is the reason why, when E.F. Hutton talks, people listen, that kind of stuff. I now have with the benefit of hindsight, I realize, well, actually stockbrokers, I mean, they get paid off of purchasing and selling securities. So he's not just going to put you into a pile of good stocks and then, never do anything else again,
Right.
because he's not making any money. I'm sure that he thought that what he was saying was true. I don't know whether that was necessarily in their best interest. But I guess my point is that in the ETF landscape, increasingly active management, much like a mutual fund manager would do or a hedge fund manager would do, is common. And in order to do that at scale, you have to have a systematic approach,
Yeah.
I assume. How do you screen? How do you do it? What does your day look like? How often do you evaluate the stocks that you are invested in, and how do you choose them?
If I'm looking for ideas and I'm looking for bullish ideas, I often screen by valuation metrics, so price to free cash flow, price to earnings. I do not look at price to book. I don't think that's a useful metric. And then I look.
What about tangible book for financials?
Well, it's okay for financials, but it's very very limited. It's very odd though. What is price to tangible book for J.P. Morgan right now? It's astronomical, isn't it? Something like 2.5 or 3.
2.6, I think.
Yeah. So
I was looking at it yesterday. I think
yeah,
it was
it's like
2.6.
because I was thinking about, well, I'll buy a bank at book value, and that would have kept you out of that of J.P. Morgan. So I look at those kind of things. I like to look at return on invested capital for companies that are growing and reinvesting their earnings. Because if you can reinvest and make 15 to 20% on those cash flows, then you're going to compound nicely over time. So those are the big ones. So I'll look for those for value. I do very little shorting these days, and if I do short, then I'll sell a call spread or something like that that does have some limited risk, because it seems that everything just wants to go higher, sort of no matter what. The surprises always seem to be to the upside. And I think we're kind of in a weird period right now where stocks by the CAPE ratio, for example, are at all-time highs. The market cap of stocks in the U.S. relative to the economy is at all-time highs. But what's also exaggerates that number even more, that number is even bigger than reported, is that private equity has never been bigger than it is now.
Well, or private credit.
And so, so it seems like the markets are super overvalued, and yet they keep going higher. And I wonder, one of the reasons why. I wrote a piece on the Options Edge just for anybody to read about some thoughts, about AI, because the economy is growing much faster than anybody's predicted. What was it, 4.6%? The last quarter, on the backs of people, the mainstream economists saying that we could actually be having a recession because of the tariffs and stuff like that. And I was getting into thinking about AI because labor is growing very slow. Job growth is slow, but companies are growing very fast. And it may be that margins on average are growing because people are becoming more productive by using AI in their jobs, and more AI bots are being used and things like that. And one of the things that gave...
By the way, I pulled up return on invested capital last 10 years. If you were doing the same kind of factor analysis, because I also like to look at return on invested capital. And you can see that the cumulative outperformance of the top 20% of companies, that is higher returns on invested capital versus the bottom 20%, that the cumulative outperformance over, and I was about to say 10 years, but actually I think we could just go back for 5 years.
Yeah.
And the outperformance over the last 5 years is that the higher the higher quintile has outperformed the lower quintile by 100%.
Yeah, it's
100%.
remarkable. And what's also
That
interesting
is,
about all your charts is, especially with the orange, they all seem to be peaking no matter what the metric is, peaking at the same time, at the same date.
yeah, I think that there, to some extent, I think that that's maybe not so surprising, and that is because a lot of these things are related to one another, right? So I was looking at things like free cash flow yield, I was looking at sales and earnings growth, I was looking at returns on invested capital, and the fact is that a lot of these things come from the same place. If you have a fast-growing business with expanding margins and massive amounts of free cash flow, they're going to show up on all these lists. Like, it's not like, these companies had great returns on investment, and these ones had great return on equity, and these ones had good EPS growth, and these ones had free cash. Those are not separate sets of companies.
Yeah.
They're all the same companies.
Yeah, that's true.
And I think that's one of the reasons why sometimes I think while it is important to look at different metrics as a validation of one another, it is not so critical to say, oh, it must have this and it has to have that. And you come up with this long laundry list of things that it has to have, when in fact, really what you're trying to do is you're saying, okay, well, the revisions are going up. Does that hold water? The margins seem to be widening. Is that likely to continue? And the company seems to have, very good earnings growth. And is that supported? Is that validated by what you see on the balance sheet?
Mm-hmm.
Global Crossing and Enron and some of these other companies reported very good numbers if you looked at just one of them. People who looked at more than one sometimes started to say, hey, wait a minute, the balance sheet is inconsistent with these non-GAAP earnings numbers that they're coming up with. They come up with these convoluted things, which you're like, but there's no free cash flow and the debt on the balance sheet keeps growing. So there's a disconnect here. So the reason I like to look at these metrics is not something like free cash flow. It's kind of hard to fake.
Yeah.
You know what I mean? And if you see, like, I've got big free cash flow and I've got a company and their cash balances keep going up and their debt keeps going down on a relative basis, something's working. I don't know what. I mean, it's one of these things. In fact, it's one of the reasons why when the government's looking for illegal activity, a good place to start is when suddenly people are coming up with massive amounts of cash. You go to the bank and try to deposit $250,000 in cash and find out what happens next.
Mm-hmm.
It's because probably somewhat wisely, someone's going to say, hey, wait a minute, cash doesn't just emerge out of nowhere. Something's going on. Where did it come from? And if you keep doing that, eventually someone's going to knock on your door and say, we'd like to take a look at your affairs. Well, if you're looking at businesses, what people are reporting on their income taxes is one thing. And we can kind of think about that in the way I look at the quarterly or earnings releases, which is that I assume that companies are on the up and up. But there are other ways we have to validate that. And looking at things like the balance sheet and cash flow statements, I think is the validation that the things you see on the income statement are what they appear to be.
Mm-hmm. Yeah, I think that's right.
Would you kind of
I think that's right.
go along with
that? Yeah. I think you hit it. I think that's right.
And that's, I think, a big part of what the CFA Institute is trying to ingrain in those who are in the program as well, right? So sort of taking a broad approach, and it's not that there's some super magic in any of the many things you can look at, but that it's when these things are consistent with one another, that it gives you greater faith, essentially, in your analysis.
No, that's right. So we teach focus on the fundamentals, value. You think about you want a company that is fairly priced or cheap today, but then they're going to reinvest their capital to grow and get high rates of return on it over time. That's going to be a winning stock. And so that's that sort of core of what I go look at when I'm looking for bullish ideas. And then there's some things that I know that are out of favor. I've really liked a lot of the mining companies, the big diversified mining companies, and I've liked companies down in
Like
Brazil.
the Freeports?
Yeah, the Freeports,
Southern
BHP,
Copper, maybe?
BHP, and Rio Tinto. It's the big one down in Brazil. Um, uh, I've liked those companies, and they've been cheap, and they've kind of been staying cheap. They're finally having a bit of their day now, and that's the one hard thing about. There's reason, why you need two things to happen. One is how you like to find a cheap stock, and then you want to find a stock that everybody else agrees that it's cheap after you buy it, because then they come in and buy it too, and help push the share price up. And then there's
I have someone
companies.
who's demanding my attention, if you can't tell.
Yeah,
you
yeah,
you had a toddler, and I'm pretty sure you've been fed.
Yeah.
All right. Well, I'm going to check on her, and we've actually chewed up an hour of our valuable viewers' time, which we, as always, appreciate. But I thought this kind of, as the year gets started, I thought it was helpful, not just to show the people the things that we look at,
Mm-hmm.
but the reasons why we look at them.
Right.
And that is to say, these are jagged charts. Let's bring up this last one just as an example again. And one of the things you're going to see here is that from 1 month to the next, it's basically up, down, right? For either the good or the bad.
Mm-hmm.
So this is, looking at something like return on invested capital it's not a good predictor of what's going to happen over the next 30 days.
No.
That's not the reason we're looking at it, though. The reason we're looking at it, though, is that if you continue to use that as an approach consistently through time, you are likely going to see cumulatively much, much better returns. And as it happens more recently, the drawdowns were much more muted for the companies that were better performing on this metric than those that were not. And then, there are things that we can look at that do have better and more meaningful predictive effects over shorter periods of time. And since when you and I talk, we talk as often as anything else about options, those are the types of things that will probably, once you've narrowed the universe to include things that we generally think are better over the long term, then we can try to figure out the trades that we're going to use on that subset of stocks in the short term.
Yeah.
Okay, well, Mark, as always, it's great to see you. And I'm really looking forward to doing more of these. And sometimes we're going to get unexpected company from Wyatt, or in this case, Sophie.
Yeah. Well, before we log off here, my schedule is now changing, of course, because I got a new school year, and Monday to Thursday I'm in class from 10:20 to 1:30. So we're going to have to push this out from 1 o'clock to, let's say, 2 o'clock. I'm 12 o'clock to like 2 o'clock, if that's okay with you.
That works for me. That's great.
Yeah, there's no.
These are normally on Tuesdays.
Yeah.
Yeah.
We'll do it on Tuesdays at 2 o'clock. That gives me about 20 minutes to. Yeah.
All right. So we will provide an updated schedule now that the class schedule for the professor is changing.
Yeah.
So that we can accommodate office hours in an opportunity when he is not actually standing in the head of the class.
Right.
Unless you want to go over to Rutgers and audit some classes, I suppose you could do that too. Do they allow people to audit your classes?
They do. We have a very interesting thing that I think if you're over the age of 55, you can audit classes for free.
And are you able to audit those classes for free virtually? Is there a camera in the room?
No, I don't add a camera.
Oh.
But if you want to show up in person, there are still a few classes that are done online, but I typically don't like online classes. And but yeah, I get some people that are doctors, and I had a physicist, and I had a guy that made movies, and he actually had won an Oscar, which was kind of interesting. attend my class.
Well, I want you to share with me who that was. I would be very interested in meeting or talking to. Well, if it was depending on the nature of the movie, I suppose. But
Yeah.
that could be quite interesting.
Yep.
All right. Well,
See you later.
to those of you who tuned in for this one or who are watching it recorded, we always appreciate that. Like, subscribe. But something else that could help you and it can help us is if you leave a comment in the bottom of this video and possibly include either questions or topics that you would like to see us address in future videos, and we'd be very happy to try to do that. Thanks for watching.
Cool.